Hello, dear guests. I am delighted to be here today and present to you the main aspects of raising capital to help your business go international. My name is Ulyana. I am co-founder and chief capital officer of HighCastle, the UK-based fundraising and cap table management platform. We provide companies with a SaaS solution to manage investor pipeline, close deals with investors, issue securities, and manage investor relations in one single place. I have over 10 years of professional experience in banking and finance, and most recently, before founding HighCastle, I was an executive director of the Warsaw Stock Exchange office in Ukraine. I have worked with a number of public and private companies which were raising capital to finance new products or expansion of their business. Well, it's cheaper to hire employees locally, especially if your company is from Eastern Europe, India, or Asia. Companies choose to expand internationally because of six main reasons, which were defined by European founders who expanded to the US. Pursuit of new customers at the bigger markets such as US, Western Europe, or the UK is a key reason for your company to expand. Strategic partnership is the second core reason for expansion, especially for B2B, business to business, or business to enterprise product companies. Land grab, acquisition of talents are also on the list of factors. Some companies consider their expansion, especially often to the UK and US, because of the local investors leading the funding round and supporting expansion to their country. Such funding rounds usually would lead to IPO on the local stock exchange. Expansion path is different for different companies. Index Ventures published an amazing guide for European entrepreneurs expanding to the US. Index Ventures distinguish four main archetypes for expansion, which are measured by the extent of presence in the region, by the percentage of the total employees, and percentage of your revenues generated in this region. First, they outline the compass, the extreme pivot to the US, meaning that more than 50% of revenues are generated in the US and all executives are based there, while engineering hub stays in Europe. Transplant is even more extreme version, where the full team executives and engineering relocate from Europe to the US early in the journey. The Anchor and Pendulum are more modest expansion models with 15 to 50% of your total addressable market in the US, but executives and rest of the team based in Europe. And finally, the Telescope marketing-based model of customer acquisition fully operated from Europe, but with VP of Business Development and few employees in the US. I encourage you to try Expansion Plan web app designed by Index Ventures to discover your archetype and see practical recommendations about your expansion. Best practices shows that company has to raise capital to finance its international expansion. Money would help you finance the localization of your product and its compliance to the local regulations, grow your competitive advantages, and hire local talents. Over the past 10 years, companies choose to expand internationally rather later than sooner, at least after raising Series A round or after Series C round, if most of your total addressable market stays in Europe. As a founder or executive, you need to have a comprehensive understanding of your business state to choose carefully how to finance your growth and expansion. Reach a right investor at the right business stage and you will save tons of time for yourself and your potential investors. To build your product, you would need your own savings, tech co-founder, and potentially family and friends contributions. Companies on a pre-seed stage already have MVP, minimum viable product, and early users or customers. To raise up to 1 million at pre-seed stage, you should approach angel investors who have professional experience and personal interest in your industry. At this stage, you also can apply for grants or choose crowdfunding, but raising money from retail investors through crowdfunding is working significantly better for B2C, business to customers products, as such businesses are much easier for understanding by non-professional investors. To raise a seed stage investment from 1 to 5 millions, you need to have already about 15-20 K MRR, monthly recurring revenue, and your product market fit have to be confirmed by users and its reviews at Trustpilot, Capterra, and different other sites. Now you can approach VCs and convince them by your traction. If you get to and close a seed funding, you are super lucky and hardworking entrepreneur, that's for sure. Series A is the first growth round of investments, which might be your first round for the expansion to closest markets. If you are raising Series B or later rounds, this means you're working at scale and raising money to go really international, I mean overseas. For that, you most likely will get local VC or private equity fund leading or co-investing in your funding round. Once you clearly evaluated your business stage and what investor type does it fit, fun begins as you start to manage your investor pipeline. Usually companies do it on spreadsheets, but as digitalization era is taken over, more companies choose HighCastle or similar virtual deal rooms to create a list of potential investors, make the distribution of your investor proposal, and after a successful meeting with a number of investors, finally proceed to completion stage. The earlier stage you are, the more rejections you will get, but you just need to keep going searching for prospects and where possible introduction to the investors who are right fit for your business stage. And remember, only right fit for your stage. Cold emails distributions is also okay. As long as you personalize most emails, referring, for example, to LinkedIn connections, some activities of specific investors, for example, his article on a blog. I rather would skip angel investors, VC and private equity who invested in your competitors. They most likely will not invest due to potential conflict of interest, but will definitely share your website with your competitor which is in their portfolio. When you get to the due diligence stage with an interested investor, you will be asked to share your cap table and bank statements, which you can do, for example, automatically through the deal room on HighCastle. Once the agreement is signed, you can proceed to issuance of shares in 4 simple steps. The first step is to issue board resolution. Board resolution, which is signed by directors of a company, should confirm the issuance of the shares to specific investors. And the second step would be to submit CH01 form, return of allotment of shares. And this is UK-based form, but there are similar forms in each country. A third step would be to update a company's shareholder register, or in the UK it's called Register of Members, and it's a responsibility of a director of a company to maintain this register up to date. And the fourth very important step would be to distribute share certificates within 2 months of the issuance of your shares to investors. During the life of your company, you will decide to issue different type of securities. Usually companies issue different type of ordinary shares at different funding rounds, ordinary A, ordinary B, ordinary C, or for example convertible notes at really early stage of a business. Some VC may ask you for preferred shares, which would provide them with liquidation preference and, what is even worse, with participation rights. Preferred shares with 2 times multiple is kind of double debt for your company. If you happen to end up with VC holding preferred shares, so it's most always would be a result of funding round closed at valuation which is too high for your stage. Another very interesting instrument is an equity options. Equity options is a good tool to motivate your employees and advisors by granting them options to buy your company shares at the IPO event at a strike price, fixed price, at valuation as of today. And debt instruments are issued usually by more traditional businesses at later stages. At the IPO event, different shares of company will be converted into ordinary shares in order to unify a price of shares at the secondary market. As your company grows, the corporate responsibilities and tax reporting become more and more complex, and very likely you would need an accountant or CFO in your new market to maintain the compliance. Let me cover 4 main aspects of directors' work to maintain the corporate compliance. The first one is to keep your company registers up to date. As a company director, you have to maintain the register of secretaries, register of directors, register of members, it's your shareholders, register of applications and allotments, which is a result of your funding round, register of persons with significant control. The second aspect of responsibilities is to keep your finance and accounting records up to date. And actually you can be fined if you're not doing it correctly. So for that reason, company directors usually would utilize Xero or QuickBook or other software which helps them to maintain this company accounting records. The third aspect of your responsibilities is to submit a company house filings or changes about your company. And similarly to UK, you will have a respected authority in your new market to submit these filings. So among those filings, you need to inform company house about changes to your persons with significant control, changes to your structure. As we said before, it's also CH1 form informing about company house about new issuance of shares. You need to update company house about changes to your name, your address, even your accounting reference date. And you also need to inform company house about new appointments of directors and secretaries, and on annual basis submit a confirmation statement. While during the year, company directors are responsible to maintain the register of shareholders and record any transfers of shares or other securities. Confirmation statement with whole list of shareholders and transactions is mandatory for submission only once per year. If your company is with long list of shareholders and transfers, so confirmation statement could be a real nightmare for you. Therefore, more CFOs and directors now utilize cap table management software to maintain the cap table synchronized with your registers fully automatically and connected very often with the company house filings system online. So the other aspect of your responsibilities as a director of a company would be to passport resolutions. So with your board of directors, you will pass a resolution about change of the company name, removal of appointment of the director, changes to your articles of association, and basically any important decision have to be recorded through the board resolution in your company. Because of the whole complexity of maintaining equity, debt, securities, and options and compliance, more and more companies choose to migrate their cap table and consequently register of shareholders to the digital platforms. While it's not popular among companies at their early stage, but closer to your institutional funding round, you will start to model scenarios and get your current cap table ready, as you will be asked to disclose it at the due diligence stage of investment. Investors love to see companies' records properly organized and accessible in a digital format. Platforms such as HighCastle allow company officers to automate share transfers, options vestings and exercises, distribute share net and option certificates. Digital software makes automated conversion of convertible securities through the approval of directors and calculate dividend or interest payments. Sounds amazing, right? But it's actually true, and cap table management software revolutionized CFOs, accountant, and lawyers' work the same way as CRM automated and revolutionized the work of the sales team. In addition to professional cap table management, at HighCastle, we automated the whole process of fundraising. Issuer has investor pipeline manager, investment deal room with legal templates, e-signing and access management for documents, and even direct issuance of securities to the cap table really in 2 clicks. It's super convenient and cost efficient to have both your issuer and investor portal in one platform to support your ongoing compliance and investor relations. For example, when you share in company updates with a separate group of your investors or option holders. If you're raising your pre-seed or seed funding from angel investors, HighCastle deal room with legal templates, prospect management, and order book would be extremely useful to manage potential investors and close a deal in days instead of months. If you're currently raising funds to help your business go international, or you at the late stage of your seed round or later, so you additionally can access contacts of institutional investors through our investor matchmaking tool. While we are not providing you with the introductions, HighCastle software allows you to find professional contacts and distribute your emails directly from your domain. So actually, you are in full control of communication with your potential investors. You are the one to impress them with your traction, your growth opportunities, and transparency provided through your digitalized deal room. I welcome you to visit HighCastle to explore a number of our free and paid tools for growing companies at different stages. I really hope it was useful for you to learn how the modern fundraising looks like. Reach me anytime for a free consultation to help you with your fundraising journey. Now I'm happy to open the floor and answer your questions. Thank you.